name is Harriet Richardson. I'm an associate in the lifetime planning team in Ipswich. Everyone has an allowance of £325,000 that they can leave, minus any lifetime gifts, free of inheritance tax. This is known as the nil rate band. Generally speaking, anything above that amount is taxed at 40%. However, there are other allowances available. For example, if you have a property which you leave to children or grandchildren, you could qualify for a further allowance of £175,000. This is known as the residence nil rate band. These allowances are transferable between spouses, and so if they're all available, a married couple could have up to £1 million before inheritance tax is payable. This is dependent on circumstances and eligibility, so I'd always recommend you come to see us for some more bespoke advice. Apart from spending, gifting is always a good way to reduce the value of your estate. Anyone can leave gifts of up to £250 to as many people as they like without there being any tax consequences. This is known as the annual small gifts exemption. You can also leave gifts totalling £3,000 in any one tax year without there being any tax consequences. If you've not used the allowance the year before, this can be brought forward, but you can only go back 1 year. Additionally, you can give away £5,000 to a child towards a marriage and £2,500 to a grandchild towards a marriage, in addition to the overall allowance of £3,000. The value of any gifts in excess of these allowances will be brought into your estate if you were to die within 7 years of the date of making the gifts. If you outlive the gifts by 7 years, they will fall away. There is a further allowance known as gifts made out of normal expenditure out of income. This allows you to pass any excess income that you are not spending to individuals without incurring any adverse tax consequences. Detailed records must be kept and there must be a pattern of giving. This is independent to the aforementioned gifting allowances. Be careful not to give too much away. You don't want to leave yourself short. If you decided to put your home, for example, into your children's names but remained living there, it would be classed as a gift with reservation of benefit. This means that its value would still be taken into account on your death as though you owned the property in your name, and so would still be subject to inheritance tax. For this to work, you would need to pass the property to your children and then pay a market rent to remain living there or leave. Also, if you did give your home to your children and they then divorced or came into financial difficulty, the house could be sold and taken from you, or equally, the children could kick you out and sell it. The spousal exemption ensures that any money passing between spouses is free from inheritance tax. Money passing to charity is also free from inheritance tax. It's worth noting that if you have a taxable estate and you leave more than 10% of your estate to charity, you could qualify for a reduced rate of inheritance tax at 36% instead of 40%. Make a will. It's very important to ensure that not only your assets pass to the right people, but it does so in the most tax efficient way. The details for myself and my colleagues are available on our website, so do get in touch.